When I was broke, I had rich habits. When I was broke, I had rich habits.
All right, welcome listeners, viewers of the Canadian Real Estate Channel. This is the Master Keys. I'm Chandler.
I'm Neal.
And we're going to talk to you today about a potential collapse in the multifamily industry. Obviously, this is something near and dear to your hearts. It's everything to us. If you want to check out our podcast, Master Keys, all we talk about is the market, investment in real estate, news headlines, all that stuff, but from a multi-unit investment standpoint. But we're going to talk about how the changing times we're in, the interest rate fluctuations, the overall sentiment in the market, the challenges this is posing for investments. Is that going to cause a collapse in the multifamily market in the same way that housing markets across the country are collapsing? So, Neal, thoughts?
Yeah, totally. Well, let's introduce ourselves first.
Okay. Yeah.
So, like you said, we're the hosts of the Master Keys podcast. We're realtors. That's kind of our day job. We're also investors. We both have roughly about 100 units, I would say.
Yeah.
We manage our own properties through our own staff and due diligence, I guess we do ourselves.
Yeah.
And we just, again, we started the podcast to try and get into all those things. So, we're going to dive into this right now. Like Chandler said, it feels like the market might be collapsing. There's been a few rate hikes, and single family and condo markets are pulling off really aggressively. Volumes way down. Prices are coming down across the board. Centers, they're down a little bit, but auxiliary markets seem to be coming down like 20-30%. And this is just the start. We have another big rate hike coming in. Not sure when this will be released. It'll probably already be.
Yeah, I mean, July 13th, Bank of Canada is meeting again. They're going to likely raise rates by 75 basis points. A lot of us investors out there, I mean, we've been going through massive expansion the last few years. Yep. We've been very fortunate growing our portfolios to, multi-millions of dollars off the strength in large part of cheap money and, great cap rates like we've all done. So a lot of us are on variable-based products because that's how the numbers work best. But this is a numbers-driven industry, so when things are great, they're great. When those numbers sway in the opposite direction, it puts more pressure on debt service ratios. It puts more pressure on loan-to-value, all of these things. And here locally, we're going through rent control, and that sentiment that's probably affecting people across country. So lots going on, man. And there's reason to believe that to some degree the good times could be slowing for us multi-unit investors.
Yeah, and we've had a great time here in Atlantic Canada.
It's been a good ride.
It's been a great ride. We were so cheap. For any of you guys, anywhere you're listening, we were buying things for $60 a door frequently. $60-$70 a door was not outrageous
About
to
5
think.
years ago, that was like fairly common for distressed property.
Even 3 years ago, I feel like that was, you saw that out there.
Depending on location,
And then it got to about $100 a door, and it leveled out there for a while at $100 a door, and then you started seeing things go for $140, $150 a door, and now it's not uncommon to see $200 a door.
Yeah, and this is for not new stock. This is kind of mid-century wood frame walk-up, Class B type product, and usually rented below market. And we've all done effectively the multi-unit equivalent of the BRRRR model, right? Where you take these distressed properties, you renovate them extensively, you get to market rents, you refinance, but that last part, that refinance, is going to be the tricky one. And there's people who are mid-project or did a project a while ago that they're currently refinancing, and they'll pull out the lift that we all love to get our cash back and take on our next project. That's not a sure thing right now.
Exactly. And so like as Chandler's alluding to, it's interest rates have forced payments up dramatically. Everyone understands what happens when an interest rate goes up. Your payment is made up of a principal portion and an interest portion. So when your interest rate goes up 50 basis points, and now it's going to be a total of 125 basis points on your refi, that interest portion might go up by 20, 30, 40, even 50%, even up to double, depending on where you're at. If you were at a 1.5 rate when you first started the thing, it could literally be double on the interest portion. And most times the banks will level it out. They'll reduce the amount of principal that you're paying, but still that overall payment increases. And with that, they're going to say you're not going to be able to service that debt when it comes time to do your refinance. And so you might not get the full 75 out. And I know for a lot of you guys listening, if you're in Ontario and you're in BC, I think you're very used to this. You guys work with lower cap rates and lower LTVs, but in a lot of these sub-markets, the reason it's been so fruitful for so many of us is that we're getting 75% on a conventional takeout and 85% on a CMHC takeout. So but again, if you ran your numbers and you saw properties sell where they literally were going right to the value of this is the property value, this is the renovation value, those two combined equals 75% of that end value. And so if you're relying on that to pay things out, whether it be investors, private capital, renovation loans that are at higher interest rates or need to be paid in a certain timeline, you can be really, really stuck
Yeah.
with those items. And this is where we're saying, will this cause a collapse? Will this be a tight thing? And even if rents do stay strong, will the interest rates outpace that?
Yeah, and a lot of people are in rental markets where there's caps.
Yeah.
Right. So yeah, the market demand for rent is going to continue to go up. I'm a firm believer in that. However, if you're in a situation where you can't raise your rents, you're jammed between a rock and a hard place there. A little example is I've never had to put more than 25% down on a multi-unit property, and I'm closing 12 units for 1.7 million in a couple weeks here. And the best I could do was 62-38 loan to value ratio. So I'm putting down 38%. And my whole model with that is to extensively renovate that property and do a refinance at the end. And I'm kind of looking at my carrying costs are a lot higher. My down payment's a lot higher. And I'm hopeful that 24 months from now, when I'm finished the renovation and the rents are normalized, that rates are going to be back down a little bit more.
Yeah.
And I know you're going through a refinance and the numbers aren't as sweet as you were maybe hoping when you started the project.
It was like auto approves before. Before it was I'd get them rented up. I was beating the rents in the appraisal. Boom, you want your 75%, you're good to go. Once you get enough that you want to do a CMHC takeout, here's your 85. I talk about it in one of our Patreons. I got 88% on one of them because we beat the debt service ratio so strongly. They're like, yeah, sure, we'll go a little higher on this thing because we think the appraisal is actually a little bit low. And so I got that much money. Now it's like fine tooth comb. They're considering other properties. They're looking at my income, all to hit the DSCR that we need to cover it. We got a little BlackBerry. Chandler still uses
that's nostalgia
BlackBerry.
for some of the investors out there still rocking the BlackBerry.
You plug a full size outlet plug into that, like the regular. It's actually a 110 that goes into the wall.
Man, I've done a lot of deals on this sucker.
Yeah.
I love her.
A couple of the buttons are stuck down.
Yeah. No, but it really is. It's a changing market, and I think that people can't bury their heads in the sand about this, right? We're going to all have to sharpen our pencils. I'm reevaluating deals. We're kind of both taking pause because we've been on full growth mode. I mean, I think in the last 36 months, I went 15 unit, followed by an 8 unit, followed by 6 unit, followed by a 12 unit, and about to take on about another 30 doors.
Yep.
Off the strength of pretty affordable money, really solid refinances in our market here locally. We're in Halifax, Nova Scotia. I don't even know if we mentioned that.
Yeah.
Booming market. And now it's like, okay, I'm going to execute. I'm going to close on these transactions. But moving forward, I may have to take a pause.
Yeah.
And I think I'm going to have to let some of the dust settle. I know you're thinking the same way.
Yeah, so same to Chandler. About 2 years ago, I had 5 doors. Today, I think I've mid-90s, maybe around 100, I think. I don't exactly know. But I'm now pumping the brakes. I was in full growth when I was buying. And I said to Chandler, like, I had not been under a purchase and sale contract for literally 2-3 years. Like, I'd always been buying or selling or doing something. And right now, I have nothing going on, and I'm pumping the brakes hard.
He's so chill right now.
Yeah.
And I'm incredibly stressed because I've got multiple.
You wouldn't
deals
know
closing.
by the hairline, but...
Yeah, he lost his hair the last 3 years, and now I think it's coming back.
I think it's. I saw some little spikes there, like little alfalfa.
Little baby hairs.
They're coming back. The other thing we haven't mentioned, going back to again why we're saying there might be a bit of a change in the multifamily market, is these interest rates will cause an upward pressure on caps because transactions will not go through for what they're going through before. Because people will have to put down more money. And so whether it's a brand new building or an old resale building, they are still going to sell for slightly less with higher interest rates because people can't service them and or don't have the down payments available. Once that happens, if you're mid-project, it takes you 2-3 years, your original appraisal is no longer valid. They're going to want a new appraisal. And let's say you got a 5.25 cap on your refinance or on your end value appraisal when you started. They might come back and look at it with 5.75, 5.5, and as you
100%.
all know, a 1/4%
so. Like,
cap
that's going to be what the market's bearing.
It's such a dramatic change on an end value. So between that plus the debt service that you have to change, again, the takeouts can change so dramatically. Long term, you'll see it all come back because you're like, look, I'm actually way less leverage on this property, and when rates kind of return back to where they want to be, and values continue to rise and rents continue to rise and assets appreciate, you'll be in great shape. But in the short term, it might really neuter growth plans, which again,
100%.
When people start to lose the takeouts and there's less people buying, it has a ripple effect that kind of compounds and will have a huge impact on the market.
And listen, I mean, if you're listening to this and you rely off the BRRRR model, or if you're really involved in these OPM models, other people's money, private money, whatever it is, it's been a gravy train.
Yeah.
And
People are throwing money out left, right, and center.
people are throwing money out left and center. This is someone trying to get buzzed into one of my buildings, so I'm just going to buzz them in real quick.
And to what Chandler's saying about the OPM model,
I pressed the wrong thing. Sorry.
this is what happens when you have a BlackBerry. He's pressing the wrong buttons. You'd think where they're physically there to click, it'd be a lot easier, but apparently not. But that's the next point that we're going to make is that OPM, other people's money, there was money flowing readily, but now with interest rates and the stock market contracting, businesses slowing down, consumer demand slowing, all of these people who are flush and had tons of money available to pass out and invest, and they said, oh, look, like my business made a ton of money this year, I want to throw it into something like real estate. They're going to start pulling that back. It's like, oh, crap, my business might not make money this year, or I need to be more careful and cover stuff, or I got to pay down some debts, or my house payment went up a bunch. And so, again, those models still exist and they'll still work in some format if you find a great deal, but maybe getting access to that capital is that much harder because there's just a huge contraction. Like when the stock market shrinks by trillions of dollars, that's getting sucked out of people's accounts and they're way less flush. They feel way less incentivized to spend, right?
Yeah, everyone was trying to dabble in real estate. It's like, I've got, growth in every part of my portfolio. Why don't I take a little bit here and sprinkle it into a JV with somewhere I'm the money? They're not going to be wanting to do that. The other thing as well is as these bank offered rates, as your A lenders, they increase their rates. Private money and investor money is going to increase as well, right? If they're kind of pegging what they expect off of the bank rates, that's going to go up and up and up. And you have to be realistic that your projections that you've run on your takeouts may not be there. So what happens when you get to the end of this project and you can't refinance in order to pay out your investor, right? Let alone get your own cash back to do it again, but you can't pay them out.
Yeah. The other item, again with OPM, with other people's money, is sentiment. When every news headline's like, oh, this person made 35%, and another person that got a refinance and got a ton of cash out of it, they're like, I want to put money in that market. It's like, I feel like crypto for a lot of people where it's the FOMO. You hear that your friend just doubled their money on crypto, and then you're like, oh, screw it, I'm going to dump it in. You don't necessarily know what it's about, but you saw that someone made money, so you do it. It was the same thing with real estate. Everybody knew somebody that sold a house. Like, oh, my uncle sold a house and made $400,000. Or I know a guy who owns a bunch of rentals and he's bought 50 more because they're just going up in value so fast. So then you feel like you're missing out. So you're interested in putting your money into that. But as the news headlines now say, volume's way down, prices are down. There's all these issues taking place. There's all these rent controls. Things are changing. It's going to be, again, the same thing. There's that contraction where people are like, I don't know if I really want to get into that area. Yeah. Like, I'm just feeling a little nervous. There's a lot of negative stuff going on. I know for a fact that I had someone from Ontario wanting to invest out here who pulled the plug and said, hey, there's a lot of negative sentiment in the market here in Toronto. I'm not feeling comfortable to invest out there, even if things seem okay. Like, by what I'm seeing around me, I can't sleep at night knowing that I'm dumping my money into that.
If they're in the suburbs of Toronto, they're like, well, damn, I just lost $300,000 on the value of my home.
At least.
Maybe I don't want to be so frivolous with this money that I was going to invest in a new market that I'm not that familiar with.
Yep.
Right? So that sentiment is real and it has impacts on what people do. But also, if you're into this and you're doing it professionally, you believe in the numbers. Right. So I know there's going to be people that listen to this and be like, oh, that's doom and gloom. That's BS or whatever. It's still going to be good. People still need a place to live. And all of that is true. Real estate is still the best investment you can make, in my humble opinion. And
totally.
The long-term trend is upward. Even if you look at these cycles, these ebbs and flows, they ebb and flow on an upward trajectory. So I am confident that 18, 24 months from now, rates are going to normalize. We're going to be back in great shape. However, in the short term, if you do this professionally, you believe in the numbers, and then you understand empirically why an increase in interest rate is going to put bigger pressure on your debt service coverage ratio, which in turn is going to affect cap rates moving forward, which then has an inverse relation on the value of these properties. They're going to have to trade for less. They're going to refinance for less. If you're going to hold, that's fantastic. Just know that your pullouts aren't going to be nearly as good if you have private or investor money. You may not be able to cover that. You may also not be in a position to take your equity and repeat it again. And that's fine if you're holding and you can get into a holding pattern. But it is a time to not necessarily be bearish, but just be a little bit more cautious, sharpen your pencils, make sure you're doing the right prudent things to protect yourself.
Yeah. And the last item, again, that we're saying is what we think might have an impact on the market. And again, I'm with Chandler where I believe that in 18, 24 months, things are going to resume on a growth trajectory. We're going through a little blip where it's going to kind of wean out some of the bad projects, some of the bad investments, and make people make some moves that they don't necessarily want to make, but they have to make to keep things alive. But is the inflationary pressure that's taken place on all of the materials that you buy and the labor costs.
Yep.
And again, same thing. Maybe in 18, 24 months, things will come down. And we've already seen some wood costs and certain
Lumber's
materials.
Lumber's down about 40-50% since the start of the year, which is great. But there's still a big-time labor shortage.
And it's still up from where it was.
Yeah.
This is the thing to never forget is that 2 years ago, or even a year and a half ago, you could buy stuff still for cheap. And so things will come back down, but they won't necessarily be as cheap as they were before. And on a singular project, that might be the difference of $10,000, $15,000. But if you're doing, again, a multi-unit building, that can have a really strong impact on what that means. Even on a small property, that has a huge impact. When your budget goes up by 10 or 15%, like that is the difference between, that's what your takeout is. Like that might suck up your takeout.
And let's be honest, the last couple of years have made geniuses out of people who, stumbled upon something great.
Totally.
And everyone can make money in real estate in a booming market. In a down market, it's only the strong that survive. Yeah. And I think if you take, if you say the multifamily market is collapsing or these things are collapsing, I'm not saying they're going to zero. I'm not saying the space disappears. It's still very lucrative, all these things. Just the transactions and the cash pullouts are going to drop off. And if you just kind of extrapolate that where there's not going to be many people spending as much new money, all these things are going to contract. But if you're interested in this sort of content, this is what we talk about every single week on the Master Keys podcast. We're on Instagram, we're on TikTok as well. So if you are into this stuff, check us out. And we're not all doom and gloom, I promise. It's just this is what's going on in our world right now. But there is reason for optimism long term. I think the cost of construction coming down a little bit is something we're all very much looking forward to. And that is going to happen, hopefully. Yeah.
So great. And then on the flip side, there's a lot of reasons on why this market should maintain some strength. And like you just alluded to, construction costs will likely come down. They already are starting to, and I think they will kind of continue a little bit down. They will, I think, still balance out at a higher rate than they were 2 years ago, which will change everyone's numbers and put a lot of projects on pause. But with that, I believe that CMHC, the government, and the banks will change. Banks, due to requirement from the government, will change financing policies because we hopeful. Need the units. There's just a demand for units. Even if we were to stop the immigration today, there's just a shortage of units for us to have a stable market. Yeah. And so the government's going to have to put in some implications through CMHC that will allow us to build. And so that will, with the lower construction costs and longer amortizations and maybe lower rates, it'll reinvigorate the market and make a lot of projects viable again.
Yeah, and that's a hypothetical, but you have to think, because that hasn't happened
Something
yet, but
has
you have to think the federal government,
start deporting people?
The major banks are going to have to look at ways to incentivize new construction while also mitigating inflation, which is a hard thing to do. But CMHC just released the report, and it's something like we need an extra 3 million homes above our current capacity to even start making a dent in affordability. So something's going to have to change there, because a lot of projects right now are getting shelved because the numbers flat out do not work. And again, if you're doing this professionally, you either believe in the numbers or you don't. Now's the time to believe in the numbers and actually put stock in them and understand them. So a lot of those projects are getting shelved. However, on the flip side, reality of inflation, rent's going up too. And you can already see that everywhere. If you look at some of the stats, to Toronto, it's going nuts.
We've just heard from some of the people that we correspond with in Toronto that it's starting to get to a point of a bidding war. And this is just very recent. But this is what I was going to say is inventory remains extremely low. And on the rental side, when rates go up, it actually tends to impact a lot of single-family buyers worse than it does for multifamily buyers or multifamily owners. And so you'll see a lot of single-family buyers are saying, you know what? I see the market going down. I'm also not approved for nearly as much as I was. I'm going to park this purchase for a year or two. I'm going to rent. Mm-hmm. And so you're seeing this huge shift towards renting. And so again, that's going to put a really strong upward pressure on the rents, to what Chandler just said, where there's literal bidding wars, what we're being told in Toronto right now. And if you're in Toronto, comment, let us know. Is that actually the case? If you're in BC, let us know. Is that actually the case? We're not seeing it quite here yet.
There have been lineups around major markets for people literally lining up for hours just to view an apartment that is under market rent as those market rents continue to rise. So these places just get pushed up and up and up. On Manhattan, the median average rent is now up to $4,000 in New York. Across the U.S., single family rents have gone up about 14%.
Yeah.
So this inflationary pressure, while it's affecting a lot of things on the expense side, your mortgage, your costs, all these things, it's actually going to put a lot of upward pressure on rents, and that can help stem the tide a little bit. So there are some good things that will come out of this, but it's going to start with people being very accountable to their numbers.
Exactly. Yeah, and this is the thing. I think again we're not seeing it here yet, but I will say like when we post an ad, we still get we're getting 60 to 80 replies.
Oh yeah,
for a unit. Like, and it's filled in 2 seconds. And people are doing applications before they come. They're willing to send deposits before they ever show up. So this will help get us through this. And you just got to be really diligent as an owner, making sure you're getting the top rent. And yeah, some people say it's greedy or whatever, but you got to do it because no one's going to protect your back as the rates continue to climb and the costs and expenses for insurance go up and maintenance goes up. So you have to do that because that's going to protect the value of your building and allow you to weather the storm for this.
I think also this is going to sound slightly insensitive, but there's going to be there are going to be people listening to this that are going to struggle, and they are going to unload properties at discounts to some of the rest of you who will be able to pick these properties up at good prices in the longer term. So those who have cash or access to cash in tight times can be really opportunistic. You know, that saying about the best time to invest is when there's blood in the streets. There's going to be some people upside down on projects right now who, again, may have done great and could do no wrong over the last 24 to 30 months. Well, if they've had this cavalier approach and they haven't run their numbers, their takeouts are going to look not great. And whether they are trying to leave 20% or 25% or even 15% in the property, if they can't get that, they may effectively have to walk away from that property, and you could get it for 15-25% under value.
Yeah.
And this again is that downward pressure on values of multi-unit and investment properties.
Exactly. With all that being said, so you just mentioned the one thing to be looking for is some new deals coming up in the market.
Yeah.
What are you thinking about, like, where are the opportunities? So we've given a lot of doom and gloom. We've said it's also some opposite of, like, why we think the market is going to do really well. And we're both strong believers in that, obviously, because we continue to invest in it. Mm-hmm. But what do you think are some good things that people could do to protect themselves moving forward?
I think try to keep some liquidity, right?
Yeah.
Because both in the real estate space and the market in general, like the market's going to continue to get dumped on, right? I think there's going to be opportunities there for those who have access to liquid cash. So yes, you don't want your money sitting in a bank account because it is deflating daily. That said, you could, if you were liquid, be able to time an opportunity, take advantage of a situation where someone's underwater, or put it into the market once the market kind of bottoms out here. I think also maybe transitioning from multi-unit into something like industrial or some of these other commercial rental models that have been really strong. I personally am wary of that sort of stuff, but industry and industrial rental space here, I think it's like a 2% vacancy right now. So
exactly. I think it's a good time to start looking at some recession-proof businesses and or businesses that do well in recessions, and you can start to go after commercial real estate that houses those people. And industrial is one of those things. Storage is another one that you're seeing a lot of online because people have to downsize or people are moving and they're temporarily looking to store space. So storage units can be a really great way to do that. The other thing, and this is something that I'm considering now, is to try and increase my cash flow in the short term, is doing some Airbnbs. Now, I do think that general travel will slow down between provinces, between countries, but overall internal travel within cities, domestic will still do very well. So if there's really cheap cottages or small spaces like that within your area, or even a small piece of land and you can put a yurt on it, Chandler can speak to that. It's about 30-40 grand to put on a really cool yurt. You can get $150 a night out of it. Like that's crazy, right? If you get 20 nights, that's $3 grand out of something that costs you 30 grand. Yeah. So it's things like that you'll need to do to kind of build the cash flow. And it's good to build that base right now because the other models are a little slower. So stop trying. You don't want to force something that is not working. Go with the trend at the end of the day. Go after something that gives you a high cash flow. Then when the other trend switches back, now you have this great high cash flow base and you can kind of continue with your multifamily business that you're doing.
Yeah, we mentioned two things, how periphery markets are slowing down and will slow down more than core markets. So there may be opportunities there. Additionally, in times of recession, people purge themselves of things that aren't necessities, of luxuries. And second properties, cottages, things like that, those are one of the first things people sell. They clearly sell their crypto first and their NFTs. They've been unloading that like it's going out of style.
Luxury cars.
Luxury vehicles, they unload of boats. You'll start to see those prices come down. But cottages would be in that same category.
Yep.
So maybe there's an opportunity to get into the Airbnb cottage market and ride out that as a strong cash flow alternative to hold you over in the interim. I mean, you have to be careful because those have to be good deals. And you're right, people are going to take less vacations, but you're right, they're going to take less vacations abroad. They're going to take less vacations between provinces.
That person who owned that cottage is still going to want to go to a cottage. And so they may rent their own personal cottage back or go rent another one in the same area. Do you know what I mean? So there's going to be more people on the market to rent.
Yeah. People not traveling as much abroad will stay local and rent those out. So again, if you like this sort of content, we are the Master Keys Podcast. Chandler, Haliburton,
Neal and Andreino.
Yeah, we're here in Halifax, Nova Scotia. We're the top real estate and investment podcast in Atlantic Canada. So check us out.
Yeah, thanks for listening, guys. We're a little bit serious on this one, but we're a little more lighthearted. Usually we have a little bit of fun with it. We got a Patreon, like you said, TikTok, Instagram. Check us out. We appreciate you guys watching.
When I was broke, I had rich habits. When I was broke, I had rich habits.